Hello, everyone. A huge, high-energy welcome to you all.
Good to be here.
I want to start off by just saying a genuine thank you for clicking on this video and choosing to spend some of your time with us today.
We really do appreciate it.
We know the internet is a big place. So today, we are unpacking the Mullen Group's 2025 year-end and fourth quarter earnings call.
Right.
And I know you're thinking earnings call, really?
Yeah.
But stick with us because this one was, well, it was different.
It was definitely different. I mean, usually these calls follow a very, very strict script.
Oh, yeah. 20 minutes is someone just reading financial statements.
Exactly. But this one, led by Murray Mullen, the chair and CEO, it felt less like a corporate report and, I don't know, more like a geopolitical strategy session.
That's a great way to put it. I really got that vibe. It felt like we were looking at a map and drawing lines between the U.S. and Canada.
For sure.
But before we get into the heavy strategy, we have to talk about the presentation itself. Or maybe the lack of one.
The unpresentation.
Right. I was reading the transcript, waiting for the big opening speech, and there was nothing.
Nope. Murray Mullen basically just came on and said, I'm not doing this.
He actually said he didn't want to waste people's time, didn't he?
He did, explicitly. He said they released all the data on January 19th, so there was, quote, nothing new to add.
Such a no-nonsense style.
It really is. His philosophy is kind of like, you can read, I can read, so let's not pretend I need to read this out loud to you. It sets a certain tone.
It does. And
Yeah.
because he skipped all the fluff, he just gave us the bullet points of 2025 in like 60 seconds. And honestly, it sounded pretty rough.
It was a very blunt assessment.
He used the phrase challenging across all four segments.
Yeah, and the main metric was no growth. And, you know, in the logistics world, when you have no growth, that's a massive problem.
It means too many trucks chasing too few goods.
Which means prices just crater.
Exactly.
So pricing comes under immense pressure. Murray explained that the business units had to tighten up.
Which is corporate speak for cut costs everywhere.
Right. Optimize every route, make sure every single mile pays for itself.
But here's the part that confused me for a second. He says, no growth. He says pricing pressure. And yet, they hit record revenues. How does that work?
Yeah. It's the classic difference between organic growth and acquired growth.
Okay.
So while the existing business was just trying to survive, grinding it out, as he put it, the corporate team was out shopping.
They bought two companies.
Yep. 2 major acquisitions. So the top-line revenue number went up because they literally bought more revenue, not because the economy was suddenly booming.
That makes a lot more sense.
Buying your way out of a slump.
Sort of. And looking forward, Murray dropped this really interesting checklist for when they might see actual record earnings, not just revenue.
And one of those points was about nation-building commitments. That really stood out to me.
Yeah, that caught my ear too.
What does that actually mean? Is he getting political here? In a way, yeah, but it's economic politics. I mean, when a CEO of a huge logistics firm calls for nation building, he's talking about massive infrastructure projects.
So like pipelines, energy grids.
Big industrial developments, things that require thousands and thousands of truckloads of steel and concrete and heavy equipment.
The stuff that actually moves the needle for the whole economy.
Precisely. He's implying that the Canadian economy right now is just sort of shuffling consumer goods around. For real growth, you need to build big things again.
Okay, that's a big statement.
It is. But he didn't dwell on it. He just threw it open to questions almost immediately to keep the call, as he put it, relevant.
Which brings us to the Q&A. And honestly, this is where all the real insights were hiding.
For sure.
First analyst up was Cameron Dobson from National Bank Financial. And he went straight for the big question on everyone's mind, capacity.
Right. Cameron asked about capacity tightening. You know, it's that classic supply and demand curve.
Everyone's been waiting for it.
For years now, the theory is that eventually enough trucking companies will go bankrupt, the supply of trucks will drop, and then rates will go back up.
And Cameron wanted to know, is it finally happening? Is there any actual evidence?
And Murray's answer was, well, a pretty clear no. At least not in Canada.
He started by talking about the spending diet. I have to say, I can relate to that.
Oh, we all can.
He basically said you can't trust January's numbers because everyone's broke after Christmas.
That's the spending diet. Consumers overspend in December, so in January, freight volumes just naturally drop off. Plus, he mentioned some nasty weather in the east that skewed the data.
Okay, so a lot of noise in the numbers.
A lot of noise. So his verdict for the north, that's Canada, is no meaningful capacity tightening. Not yet.
But then he pivoted. He went straight to the U.S. market, And this is where that Tale of Two Cities theme really kicks in. What's happening down south?
It's a completely different world. Murray said he'd just been down there with their U.S. teams, and in the U.S., capacity is tightening.
It is.
Yeah, demand is stronger. And the key indicator he pointed to was the spot market.
Okay, let's pause here for a second. For those of us who aren't logistics nerds, can you break down the spot market versus contract market? Why does it matter which one moves first?
Great question. So, think of it like the price of gas at the pump versus a heating oil contract you signed for the winter.
Okay, I'm with you.
The gas pump price changes every single day based on real-time supply and demand. That's the spot market. It's volatile, it reacts instantly.
And the contract is locked in.
The contract is locked in for a year, maybe more. It doesn't move until you renegotiate. So when the economy turns, the spot market at the gas pump always moves first.
And Murray's seeing those spot rates move up in the U.S.
Right, which means the recovery there is real. It's happening. In Canada, the spot market is dead flat.
Wow. That's a super helpful analogy. So the U.S. gas pump price is creeping up, but the Canadian pump is just stuck.
You got it.
And Cameron Dobson actually had a follow-up on this. He asked basically, if capacity isn't tightening in Canada, what are your customers saying about 2026 pricing?
Yeah, are they expecting a hike?
Exactly. And this is where Murray gave us that really vivid image. He called the Canadian customer sentiment a deer in the headlights.
Which is never a good thing to be.
No, it implies just total paralysis.
He said customers are sitting on their hands. They aren't negotiating hard for lower prices, but they're not expanding or planning for growth either. They are just waiting.
Waiting for what?
Waiting for interest rates to drop, waiting for some kind of clarity on government policy, just waiting for someone else to make the first move.
That sounds incredibly frustrating if you're trying to run a business. You can't plan for anything.
Nothing. Murray said there's maybe some optimism for the middle of the year, but right now the Canadian market is still loose. Too many trucks, not enough freight.
And that leads perfectly into the next question from Konar Krista at Scotiabank.
Re
She really drilled down into the why of it all, she asked. Why is the capacity so sticky in Canada compared to the U.S.? Why aren't Canadian trucking companies going bust fast enough to fix the supply problem?
This was, for me, the philosophical peak of the call.
I agree.
Murray's answer was fascinating. He compared the two economies using the phrase animalistic instincts.
Animalistic instincts. It sounds like something out of a nature documentary. What did he mean by that?
He's describing the ruthlessness of the American free market.
Okay.
In the U.S., if a company's weak, the market eats it. Bankruptcies happen fast. Banks foreclose. Equipment gets auctioned off. It's brutal, but it's very efficient. It clears out the dead wood so the forest can grow back stronger.
In Canada.
Canada is, well, it's nicer.
Yeah.
Or maybe less efficient, depending on your perspective. Murray said the weak players in Canada get recycled.
Recycled? What, like they get a second chance?
Sort of. Instead of going bust and those trucks actually leaving the road, a failing Canadian company might get refinanced by the bank.
Ah, so the bank extends the loan terms to avoid a write-off.
Exactly. Or a competitor buys their assets for pennies on the dollar and just keeps running the same trucks on the same routes. The capacity never actually disappears.
So the trucks never leave the highway. The supply stays high, which keeps the prices low for everyone.
Precisely. It creates this zombie capacity problem.
And he also threw a little jab at the government here, didn't he?
He did. He mentioned that the U.S. is using regulatory tools like English proficiency tests for drivers to actively shrink the driver pool and tighten the market.
And he was very blunt about Canada's position on that.
Yeah, he just said Canada is not going to do that. So you have the situation where the U.S. is aggressively flushing out capacity while Canada is trying to retain it. The result, the U.S. recovers faster.
That is such a stark difference.
Yeah.
It really shows how policy and business culture can create totally different outcomes.
Absolutely.
Okay, so Konar Krista had a follow-up about their future numbers. Mullen Group is projecting about 10% top-line growth for 2026. She wanted to know where that growth is coming from, if the Canadian economy is a deer in the headlights. Is it new M&A, or is the market actually going to get better?
And this is where Murray and his CFO, Carson Urlacher, kind of tag-team the answer.
And the short version is,
we have to buy the growth. Murray was crystal clear. Organic growth is dead in the water right now.
so it's all acquisitions.
Mostly. Carson broke it down by segment. He said LTL, that's less than truckload, is projected to be flat. But the S&I segment, specialized and industrial, is where they see some growth.
Okay, why there? What's an S&I?
S&I is less about moving boxes to a grocery store and more about big industrial projects. Carson mentioned they push a lot of CapEx into their disposal facilities.
Disposal, like industrial waste management.
Exactly. And they're expecting a bounce back in turnaround work and mining projects. These are the big industrial maintenance cycles that got pushed off in 2025 because everyone was trying to save cash.
You can only delay that stuff for so long.
You can only delay maintenance on a mine or an oil rig for so long before things start to break. So that work has to come back in 2026.
And this connects to that one specific acquisition Murray kept mentioning, Thrive.
Yes, the Thrive deal. This is a really strategic move. They already owned a piece of it, but now they've bought the whole thing, 100%.
And Thrive isn't a traditional trucking company, right?
Not at all. It's a water management and industrial fluids company.
I have to ask, why water? I mean, they're a freight company. Why are they getting into water?
It's a brilliant diversification. Think about it. Freight is super cyclical. It booms and busts with the economy.
Oh.
But water management, industrial fluids, that's way more steady. If you have a big industrial site, you need to manage the water and waste no matter what the GDP is doing that quarter.
So it's a hedge. It stabilizes their income when the trucking side is all over the place.
That's it, precisely. And Murray was really excited about the talent they got, too. He mentioned that Brian, the guy who ran Thrive, is joining their corporate team to lead this whole water and fluids vertical.
An investable vertical, he called it.
Yep. It goes right back to that nation-building idea, doesn't it?
It does.
Murray's strategy is pretty clear. Use the company's strong balance sheet to buy assets now while they're cheap and everyone else is struggling.
Or backfill the revenue hole.
Backfill the revenue holes with these acquisitions. Then, when those nation-building projects finally get going, whenever that might be, Mullen Group will have the trucks, the specialized gear, and the water management teams all ready to go.
They're playing the long game while everyone else is just trying to make it to Friday.
That's the advantage of having cash in a crisis. You get to set the board for the next decade.
Okay, so we have covered a lot of ground here. The unpresentation, the diverging North and South economies, the zombie companies in Canada, this big pivot to industrial fluids.
A lot to unpack.
If we had to boil it down for everyone listening, what are the big themes, the main takeaways?
I think you can distill it down to three main things. First, the Great Divide. You cannot treat North America as one single economy right now.
Okay.
It's not.
Not at all.
The U.S. is animalistic, aggressive, and it's recovering. Canada is cautious, sticky, and stagnant. If you're doing business in both, you need two totally different playbooks.
That is a huge point. The border isn't just a line on a map. It's an economic cliff right now.
For sure. The second is the strategy of grinding and shopping. That's how I'd describe what Mullen's doing.
Grinding and shopping, I like that.
The existing business units are grinding it, out-cutting costs, surviving the spending diet. Meanwhile, corporate is out shopping, using their cash to buy strategic assets like Thrive.
One hand saves the pennies while the other hand writes the big checks.
You got it. And finally, the pivot to complexity. They aren't betting on general freight growing. They're betting on complex services.
Mining support, fluid management.
Specialized industrial work. They're moving away from the commodity business of just moving box A to point B and moving toward high-value services that are much harder for a competitor to replicate.
That makes a ton of sense. I mean, anyone can buy a truck, but not just anyone can manage industrial wastewater for a huge mining project.
Exactly. It builds a moat around their business.
You know, I keep coming back to that animalistic instincts comment. It's just such a powerful way to frame the difference between the two countries.
It really is.
It makes you wonder, is the pain of the U.S. market, all the bankruptcies and failures, is that actually a good thing in the long run?
It raises a really tough question. The U.S. model is painful, no doubt, but it resets the clock. It clears the table.
Whereas the Canadian model...
The Canadian model avoids that immediate pain, but it drags out the stagnation. We just stay in the trough for longer because we refuse to let the failures happen. It's a choice between a sharp shock or a long, dull ache.
A sharp shock or a dull ache. That is a sobering thought to leave everyone with, but a really important one for anyone watching the economy.
Indeed.
Well, on that note, we are going to wrap things up. Thank you so much for watching and listening to this breakdown. We hope it helped you make a little more sense of the noise out there.
It was a pleasure unpacking it.
If you found this useful, please do us a huge favor. Click that like button, share this video with a colleague or a friend who needs to hear this, and definitely subscribe to the channel.
Absolutely.
We have a lot more analysis coming down the pipeline, and you are not going to want to miss it.
Stay tuned.
Thanks again, everyone. We'll see you next time.